people in, dealing with their credit policies and bad debt, there's emotion that's involved in it, right? This is actually taking the emotion out of the analysis and working strictly off of logic and the facts and the history. Hey there, Sven Nelson, C2C Resources, also known as the guy that gets you paid. I'm here with my friend, Dom Pitot. And Dom, why don't you introduce yourself, tell everybody who you are, what you do, and what you're up to these days.
How's it, Sven? Thanks.
How's it, my bro?
You might hear a bit of an accent there. Yeah, I'm South African. Moved to the US about 3 years ago. I am the founder and CEO of a business called Veruta. It's a trade credit decisioning tool that helps businesses set the right credit limits and manage their credit risk whilst they're trying to grow. Right? So I started a similar business like this in South Africa a number of years ago. Started bringing it to the US. Shareholders at the time decided not to make the investment into the US, but I moved over here, and about 6 months ago, got an investor here and set it up. So that's what I'm busy doing right now, busy building it out. It's very exciting. We've got some clients, we've got the data, we've got building models, and it's all happening. So very exciting times.
That's awesome, man. So Dom, why is it that you do what it is you're doing right now? What's driving you?
Well, so talking about 12 years ago almost, I had started my own company, which then had failed. It was a data business. And then I joined this other interesting data business and helped them set that up and grow it, which is essentially a Dun & Bradstreet kind of company for Africa, trying to get basically reports on businesses in Africa, which is extremely difficult because there nothing is digitized. In most of the countries, you have to go like to physical company registries, like their Secretary of States are all manual. And so you got people in every country running around collecting data, and we would digitize it and make this available, essentially produce a similar report to what Dun & Bradstreet could do. And Dun & Bradstreet was a big competitor. So we would be better at getting a report that actually had some information about it. And we would do the usual things too, like trade references and try and get financials and find the companies and try and complement all of that. So we were running a very interesting business, so this really mix of technology and data plus a very sort of manual side of that business. And although it was good and it's great and it's still a very successful business today, does well, I always felt like, how could you use these for credit reporting, right, or for credit decisions? A lot of it's just telling us the company exists and it's real, which is very valuable still when you're making a credit decision. But how much credit should you give them? I mean, that was very, very difficult to do from those reports. And even today, like I would say, your average credit report on businesses today has some real flaws, makes it very difficult for you to really make a good credit decision. I think we'll get into a little bit more of that. And the trouble is like there's just not data out there on companies to tell you, like, hey, how much credit should I give this guy? Well, if he doesn't want to share his financials with you, even if he does, his financials could very well be, doctored to hide a few things. And the financials are almost sometimes like 18 months old, and we haven't prepared our latest financials yet, and we'll send that to you when it's ready, et cetera, et cetera. I've heard it all, and I've seen plenty of fraudulent financials. So you're making a decision based on information that's already like 18 months, 2 years old. So it doesn't help you with, are they going to pay me this month, next month? Am I going to get my money? So even financials I found was difficult. Trade references are at best only going to tell you something valuable when something goes bad. But now you have to be very lucky to call that reference like in the week that something just went bad as they're coming to you to try and get some credit. Like most of the times you're phoning when the guy is growing his business and everyone's like, yeah, sure, he's great. And everybody wants to keep doing business, so they don't want to give a bad reference. So references are, almost never come across negative ones. And if you do, it's almost always too late. Like it's way beyond, like somebody's already defaulted multiple times and now they're really desperate. So what are you left with? Like sometimes bank references, if the guys want to give you access or some other kind of data, it's very difficult to make good decisions of those. So we tried a different approach, which, and we know other companies have tried this, and that's using trade lines. getting trade lines in from companies and making an analytics out of that. But that's kind of where this sort of new phase for me really started, was realizing, wow, like, if you do things a slightly different way, you could really get some massive value out of this. And I don't think that trade lines are really being used well, and I don't think people really understand the power of machine learning and modeling that can get you just a much more developed, a much more powerful way of making credit decisions. And there's a lot of I'd have to unpack this a little bit to try and explain to you like what I mean by some of this, but that's essentially sort of the path that I was on, was like starting in the world of credit reports, which are fine, but really don't help you with decisions. Then moving on to trade lines in that world and realizing, okay, there's some good stuff here, but why is everyone doing this as if it's still like a version of a credit report? And we've developed a kind of new way of doing that in South Africa. And by now, what I'm bringing across and doing here in the US is kind of the most advanced version of what we had dreamed of back then. So that's a little bit about that.
You have so many more tools at your disposal now with AI coming out and things like that. So what are the like the key data analytics that you guys are really focusing in right now? I mean, obviously you don't want to tell all your trade secrets, but what can you share with
Well, some of the things I learned in the last iteration was trade lines are very predictive, and they basically make everything else pointless. Like using references is always backwards looking, doesn't predict. So it's useless. Like we tested them, we had hundreds of thousands of references. They were not predictive. Like not at all predictive, just basically a useful bit of information to put on a report, but not predictive of whether the guy's going to pay or not. Even financials is quite limited. It's useful for telling you how big a company is, and obviously size does give you a sense, some sort of probability of default, which is quite useful. But whether he's going to pay his bill in 20 days or 10 days late or 50 days late, it can't tell you that actually. So it's also not really that helpful in trade credit world. So financials is great if you're doing credit risk and for loans. Like I want to know whether he's going to pay back his loan over the next 3 to 5 years. Financial doesn't really help you in the short term either. So that's a lot of that learning. So trade lines, really, really good. If you've got good trade lines, it's very, very predictive at how the payment behavior is likely to continue in the future, especially if you've got many years. You can get seasonality. You know that the guy always around, I don't know, January may have cash flow issues every year because maybe he's purchased a whole lot of stock and he's waiting to clear. And that's like they do every year. Clearance is in January and the cash only comes in Feb. And so he starts paying you better in March. You can see those trends in the data. So trade lines is really good. What I struggled with back then and what we're doing this time around is that generally the approach is to build one big model. So like you build a big model and you take all these customers' trade lines in.
Yeah.
And that means that your model on average is very good. But for every individual customer of yours, when they're evaluating their buyers, your model is not really predicting how that buyer is going to pay them. It's kind of giving you this average across everybody.
Okay.
So you might see a lot of this on reports today. Like somebody will give trade lines and you may have a credit report from, I'm not going to mention the guys, you all know the big players, and they'll have a kind of score there. But it's a score which would be useful for anybody. So, but let's say my client is a distributor and they're providing them some really key input into their process. Maybe it's a flavor for some kind of drink that they're making. If they don't get that particular flavor, they can't make their drink. Well, then you've got a lot different payment profile to let's say they're paying somebody who's doing their cleaning services. Well, dude, you can cancel your cleaning services and get somebody else.
Yeah.
So you're not going to be that diligent in necessarily paying your cleaning services provider to paying somebody who's got an input into your production. The guy's got input to your production. You want him to keep stock. You want him to supply you on time. And so you will pay those invoices better. Now that's the problem. When you've got an average across an industry, you're not getting this individual prediction that really works for how they're going to pay you. So the problem is there's just not enough data normally to do. There's two problems. One is there's not enough data generally. Do client-specific models, and the other one is used to be very expensive So if I had to come to you and say, okay, cool, I'm going to build your business specific models, normally the cost would be $100,000, $200,000 at least just to build you those models.
Right.
And then every year you're going to want some updates and refreshes, and you're going to keep paying and keep paying and keep paying, because it is complex, expensive data science work to do to get all that data to build the models. But like you said earlier, with AI these days and with much more powerful infrastructure capabilities, I can get into more detail, but basically it's much easier these days to build a machine learning pipeline, spin it up quickly, get the client's data in there, use intelligent systems. And I'm talking here a bit more about my IP, how to build this up. But basically, I can build client-specific models. So every client gets their own data, goes into building their own model to predict how the customer is going to pay them.
Yeah.
Normally, they would be paying, like I said, $200,000 would be like a minimum 5 years, 10 years ago.
Right.
Now it'll be part of our like sort of monthly fee, and we will be able to keep every month we get more data. We'll be updating those models. And the second thing is we're not using trade lines. Now we use invoice information and payment information and ERP information, CRM information, whatever else the client can give us that will help us describe their customer and their buyer better. For example, some companies we've seen, it depends what product you're selling. That will give a different payment.
Sure.
Companies who maybe poorer payers, they go for a cheaper version of a product, and they will end up paying later. Whereas your better companies are going to buy the premium version and they pay more on time. So now I'm using some very client specific data. That's not like something that's out there, right? You're never going to see on the credit report what product was purchased, but that does become a predictive feature in those models. So we collect much more data than what is typical and what you just get from trade lines, and that also helps the models to be more predictive. Anyway, more than that, I'll be giving away the secret sauce, but that's where I see the difference in going forward. What the potential is, how we can really leverage like the more recent improvements in technology to get every company out there essentially its own set of predictive models that will predict when their customers are going to pay them. And then on top of that, you build out the simulation and decisioning steps, and that's another fairly complicated piece. But yeah, does that make sense to you? Any questions?
Yeah, no, I mean, it's interesting because all along we have taken these credit reports, right, to build these analytics and in-house analysis, if you will, but it's based off, stale data, like you said, that was like produced by tons of different vendors, not just your particular company, right? So now you're essentially taking this data and building something custom for somebody else's, their company in particular, and how their customers have paid them and how their invoices have gotten, paid on time, or, how long it takes specific to their product and their company, which I think is, wow, something really, really cool. So, what do you think the biggest mistake is you see businesses making right now in their data analytics? Besides what I just described,
Yeah, so typical mistake. And look, I spent in between, before I started this, I was working with a Palantir services company. So really in this whole AI space, and if you've heard of Palantir, then there's a lot of hype around it. And it's an incredibly powerful system. I've taken a lot of that learning and applied it to this. But what I saw most companies making as their mistakes was focusing on the technology, not focusing on the business outcome that they want to achieve. And that sounds like, that's a bad idea. Don't do that. But it's really hard to get out of that mode, because typically you come saying like, oh, we need to apply technology, or we need to apply AI, right? We need to have AI. Okay. So often they run around and say like, okay, well, it must have an LLM somewhere in there. I don't use LLMs. LLMs are not good for managing data. And, we do talk about like the new tools. Really, machine learning has been around for 20, 30 years.
For audience that don't know what LLM is, so explain what is that? Just
Yeah, good. So OpenAI and ChatGPT, these are language models.
Language models. Yep.
They're really good at taking like a bit of language, and if you ask some sort of question, give you an answer, but it's all language. It's probabilistic around language. It's saying, if I've seen this and these things, then I normally will have this as an output. So
Yeah.
it's generating an outcome based upon what it normally sees, but in text. And you can throw numbers at it too, but it's pointless. It's useless. I've tried so many times to get it to analyze just the most basic things, just like a line going up. It just can't reliably analyze data.
Yeah.
Within AI, there's also machine learning is a very big part of what AI is supposed to be. And that's really just taking data and building models that can predict the future. But that's with numbers, right? It's not using language. You just take real numbers and you'll be able to predict what's going to happen. It's the target that's often the problem. Companies often want to save money by automating tasks. So that normally sounds like, this person has to fill out these forms, 10 times a day. And we would love to have a tool that can automatically fill out the forms.
Sure.
Or automatically go and upload this here and change this thing over in that system. And those are all, I'm not saying they're bad. It's just that they're often the return on investment on those is very low because you save time, maybe, although hardly ever is that person whose time is saved just cut, maybe sometimes, but generally those people stay on and just do something else. And when you calculate the time savings on, even then it's generally going to be maybe $1,000 a month, $5,000 a month. I saw clients who are spending, several millions of dollars a year on these systems, maybe making $100,000 of savings off those projects a year. Yeah. I was like, this is insanity. Clearly, what does make a big difference is changing a decision, a key business decision, right? So if we're in the world of credit, right? If you give good credit to a good customer and they can use that and go and grow their business because you're giving them working capital and they pay on time and they come back and buy more the next month and more and you're helping them grow. That's an incredible investment, right? That's a good decision.
Yeah.
And the alternative is, of course, if you give credit to somebody who doesn't pay on time and who drains that working capital and, you spend hours chasing after them and then you get Sven to go and get your money and it costs an arm and a leg and it's all that pain. If you just said no in the beginning, it would have been a hell of a lot better in terms of the return on investment. No, you can't avoid all things. It's all about how do you move the average quality of your decisions into the positive side, right? So if you can improve your decisions quality by sometimes, I would say less than 5% to 10% better decisions, the return on investment on these things is gigantic. It's just multiplicative effect. Every time you make a better decision, that just helps your business. More working capital, better customers, higher margins versus average working capital performance, struggles and difficulties all the time. And, obviously low margins, potentially you go out of business. I mean, big difference. And it comes down to making a decision at the end of the day. Now, what information did you have at the time? How are you going to analyze it? How much time did you have? Those are the factors that really come into play when you're going to make that decision. And I think that's where intelligence and machine learning, and I'm going to avoid saying AI here because I think it's really the machine learning stuff that can help you make better decisions through the ability to be able to predict the future. Maybe I should show a little graph here to give the...
Yeah, sure. Absolutely. Yeah, by all means. So what you're describing is not only a tool to help people with the analytics and the decisioning, but also a tool to help them grow their business and identify sales opportunities, right?
Yes.
That can really, if you had this in your credit department and then you're going to your salespeople and you're saying, hey, these people over here, there's more opportunity here. And you're saying the salesperson and you know what I mean? That's huge for a business. Yeah. And that's using the credit department in a way that nobody's ever used it before.
100%. I think the credit department could be such a driver of profitability in a business. I mean, in most of these businesses that we deal with, if they didn't give any credit, there would be no sales, right? No credit equals no sales, no business.
Sure.
Okay.
Sure.
So credit is an essential supporting tool for sales. We know this, okay? That's nothing new. The problem is like, on what basis are you making the credit decisions? Often as you're the credit person, unfortunately, you're punished when somebody pays late or defaults, right? You don't really get the benefit of when you made good decisions and gave good credit to good customers. That's always like considered. Yeah, that's obvious. Like
you are.
Obviously, they're a good company. Like, no,
sure.
We probably took a lot of risk on that, but we took the right risk.
Yeah.
And this is our trouble, right? So if credit overall is too risk averse, let's say the company, then your sales get reduced, right? You got lost sales.
Right.
Nobody knows how much that is. It could be potentially massive for your company. Also, if you're too aggressive, right, you could put yourself out of business, but at least what you're going to do is waste working capital that could have been better deployed. Your profitability drops.
Yeah.
Now, how do you make the good decisions, right? This is what it comes down to, and I think this is where it is not that simple. It just does not fall out of the sky. And so this is the process that I found that does work really well. One is collect as much data as you can, okay?
Mm-hmm.
Right? External data is kind of useful, but the best data we find, the most predictive data, is your own data on your customers. Okay?
Yeah.
Let's get that together. You analyze it. Okay, it's always nice to know what already happened. All right, this guy's paying later and later, or this guy's paying better, and this is the kind of sales, etc. But really, what you want to get to is be able to what is going to happen, because you're not making. Often we do make decisions on like, okay, cool, this is what he's been doing. He's been paying badly, so let's cut his credit limit.
Sure.
Maybe he's been paying badly, but getting not as bad, right?
Right.
His behavior is starting to tend towards the right direction. So maybe we actually should be enticing him to increasing his limit and letting him know, hey, but you need to keep improving your payment behavior, improving it. So actually, we've got to be looking at what's going to happen. Now that requires prediction. That takes the data in, you model it, and you say, okay, cool, based upon how things worked in the past across your entire customer base, this is likely what's going to happen in future, right?
Yeah.
So what we do is we predict the likely sales from this customer, and then we're going to predict their payment behavior. And the two together, we can predict then how much profit are they likely to make you, and then what are the costs going to be from a credit perspective. And what we do is we throw that into simulations. Technical term is Monte Carlo simulations. So you've got your predictive models, but now you run those scenarios hundreds and thousands of times. And it's really interesting. So it starts to produce for you all the potential things that could happen with that particular buyer of yours, that particular customer. And you'll start to see normalized distributions and what's likely to happen over time. So you start to be able to predict a bit better over time. They're likely to pay me 10 days late, but they're likely to spend this much with me. And so actually, on average, this customer is a very profitable business looking forward over the next 6 months with all the data I've got and all the models that I've got.
Mm-hmm.
Then you can apply your credit policy on that automatically.
Okay.
If it simulates, hey, the guy has been fine, but he's getting worse and we're starting to dip below some of our key policy levels, well, the simulation is going to show you that. And then your decision policy could be, hey, we need to start cutting back. This guy's got, he's spending 20,000 a month of, let's say, his AR, but he's got a credit limit of 40,000. Let's bring that down to 25 because we want to keep a bit of a tighter rein on this guy now.
Okay. Yeah.
What's very hard for most people to do is to do the predictive models. Very difficult to build predictive models. Difficult then to run simulations. I've got some of them running now. They take per customer generally 6 to 8 hours to run the entire set of buyers. It's a huge amount of compute that's going in there, and then the decisioning beyond that produces the recommendation. Okay, increase the limit to this much, decrease it by that much, and here's the whole reasoning why. We're able to produce a very powerful report with all this information packed into there, so that if you ever want to go back and say, why did we make that decision? All that information is there, all well structured and analyzed. So, you can make decisions with confidence based upon a sort of very well structured setup. But the key, you can change over time your decision. If
you're practically analyzing these guys 100%, like 24/7.
Correct. Yeah. They're not changing every day, but when there are changes, you update it. Yeah.
As opposed to like, now we do a credit file. I mean, we analyze. We're lucky if we just analyze it the first time, and then most people have a hard time like keeping up with their credit portfolio, like continuing to go back and renew customers and revet them. And I think that's one of the reasons why a lot of people get into trouble, right? I mean, this
process is just running continuously for you. It's like working for you and just keeps providing you with these recommendations that, I mean, you can say like, I don't like this one. Certainly if you've got big customers, it's going to be difficult for any system like this to know what's your relationship like with them. Have you got any special security in place? We can add some of that, of course, but pretty much we say, look, your top customers, you know them best. I'll give a recommendation, but you make the decision. The others, let it keep managing those credit limits for all of your mid-size and smaller customers because you don't have the time.
Right.
There's so much value in there. There are so many of those customers who would buy more if you just said to them, hey, we're increasing your limit by 50% from next month, but please keep paying on time. They will.
Yeah.
Or I'm going to cut your limit by 20% next week unless you get your overdues down. And dude, they will. But it takes so much time for somebody to do that work. So this will do it for them. That's where a lot of the value will be generated. But the thing is you got to be able to trust the decisions, and it's been very difficult to build anything that works for businesses. Mostly because the prediction, like I said earlier, they don't use a model that's specific for every customer. They have one big model, right? It just says C, medium risk. Doesn't matter who's dealing with them.
You see it on the credit reports all the time. Yeah.
Yeah. Absolutely. And how often does it change month to month? Almost never. To just stay the same forever until boom, the company goes bad, and then they're like, oh yeah, now it's a high risk.
Right. So how does this do with smaller companies that you're vetting? Smaller companies. I mean, there's still the same amount of data out there. I mean, because a lot of people struggle with smaller businesses. They can't find anything in their credit report. They go ahead and extend them credit, and then year later or so, they realize, oh man, that was a bad decision. We took a chance. So is this information used for smaller companies as well as larger and medium-sized companies?
Yeah. Primarily, it's the smaller companies where it adds the smaller and medium-sized companies really adds the biggest lift for you because
biggest value. Okay.
Yeah, there really is very little information out there. So it's primarily at this early stage, right? Collecting the data from your own systems, not just from how they pay you, etc., but anything else in your ERP. And what we do is what the model is really doing is it's profiling companies that look like this, pay like this.
Okay? Yeah. Okay.
So if we've got enough evidence in your system, we're like, hey, companies that look like this, and they could, let's say they're small but fast growing, buying a lot. In my experience, they actually tend to start paying badly quite quickly until they hit some kind of plateau, and then you lock them down, and then they normally stabilize for a bit, and then you can start picking them up again. Now, if that's the way you typically handle credit and we can see the buyers typically pay a certain way, then that's what the model will pick up. We'll say like, okay, cool. We see this new buyer with this behavior. It looks like one of your new buyers from a year ago, or like 100 of your new buyers over the last 5 years. And we can predict with pretty decent accuracy, therefore, what they're going to do based upon that behavior. But it takes into account so many things. So it's difficult to say like there's one factor. But for small buyers, this is why it still works, because there's enough small buyers within your data pool that we can pick up the behavioral features that is going to predict how they're going to pay next month.
Very interesting. Very interesting. So what is one of your client success stories with this software? Or, where have you seen this really just...
I haven't had the slide, but I didn't show this to you before. So,
yeah, sure, go for it. Yeah.
Yeah. I mean, one of the best ones I've seen with this is a beverage manufacturer.
Mm-hmm.
Had about 27,000 customers. Okay, it's very large, but really only 2,000 proper customers and 25,000 mixture of dead accounts, inactive accounts, potentially all the range, and some buying every now and then. Of whom some had credit, some didn't. And the opportunity was okay, can we activate some of these smaller customers? Who could we give credit to? And that's what they used this for. They were like, okay, cool, our 2,000, yeah, we can still use it on that. But it was really to try and use the data they had to try and identify which of these smaller businesses had potential. And it was so dramatic, the uptake of credit. They were like shocked that how could this happen? But smaller companies live off working capital.
They live and die off credit, right? I mean, that's the
If
American
they
way.
came to them and said, hey, I want to give you a credit line of another $100,000, they're going to say, nah, don't worry about it. I don't need it. No, they're like, give it to me. I'm trying to grow.
Right.
But the expectation was that the DSOs would get worse, i.e. that they would pay badly.
Okay.
But it hardly happened. Like, we were watching this week after week, and these small businesses kept paying on time. And I don't know, I don't speak to all of them, but you can see in the data that they were actually pretty good payers. On a credit report, they look high risk. But in reality, they need these products in order to run their business, and so they're going to pay. They're not like the big players out there say, I'll pay you on 90 days, and they'll still keep dragging out the payment later because they're Ariba or Coupa system or whatever is, taking time to process things. And this, you know what it is, like the big companies often are actually the worst payers. So that was the surprising thing here. Using analytics, we could identify good customers to give credit to. They accessed that credit, they purchased. And this company made so much profit off this. Like, we were kicking ourselves because we should have sold it for like 100 times what we did. But it was such a good demonstration. And I've seen this happen elsewhere. It's just that in that case, it was really like throwaway clients that they were able to activate with credit.
Wow.
So that was a really great one. And the other part of that story is that one would expect the credit risk to go up, defaults to go up, payments behavior to worsen, and it just did not. So I think there's a lesson in there for all of us in the credit industry is that, it's a lifeline that you're giving to a lot of businesses.
100%. Yeah.
And most of them need the product to make their business run. So it's not like you're giving them cash that they go and spend on a nice car, right?
Right.
People use SBA loans for stupid things, right? They go and waste the money, and then they end up in a bad situation, and there's nothing to get back.
Sure.
In trade credit, it's like you're giving somebody an input to their business that they use to generate their income, right?
Right.
And I know obviously people pay badly, and I know that the situation is not great. It's hard in this space, but I think we just need to remind ourselves that it is an essential input to these smaller businesses' balance sheets to be able to fund their business. And I think that there's generally a lot of profit to be made if we can be smart around who we give that credit out to.
Yeah. No, that's awesome. What do you think it is that people misunderstand most about what it is you're trying to do here?
Yeah, I think that the story normally becomes around, I think there's certainly the one is, I got a new buyer.
Yeah.
Who's just walked in off the street, and I need you to tell me everything that's in the bank account and to tell me exactly how he's going to pay me next month. Well, you're not going to know exactly. Never. Everything is going to be probabilistic, right? And either you got to be in business and take those risks, some of them, or not be in business at all. So I think one of the things that we struggle with in our industry, let's say from my side, the information provider and the analytics providers, that we're sometimes expected to have the answer. But we're not saying we have the exact answer on every single buyer. Like, I have the exact data on that buyer. No. The approach we're taking especially is we'll make your decisions on average better. You're still going to take risk, but you're going to take better risks. So
it's calculated
risk. Yeah, exactly. Calculated risk, but now you know where you stand. Like, am I in the really, 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 really shitty part, or am I, this is okay? Or like, it's shitty, but it could get better, and like it normally does. And if we look at how things normally go, actually we'll be okay. Or normally we take these risks and they actually tend to work out badly, but you never looked at the data that way. You were always looking at it from a very short-term perspective. But we almost always look at, there's a write-off, like a huge one. And everyone dives, why did we write that off? But sometimes the guy's been paying badly for like 3 years and you were slogging away. And that's what you focus on instead of, hey, 95% of your customers, you probably were restricting the credit to them. They were sort of eking it out and using it. Maybe they weren't. I mean, it's just that the bigger picture is all of your customers you're making decisions on every single day. And if you make better decisions across everybody, you're going to come out better. You're still going to have some write-offs. It's too bad. Like, there's just, you can't predict. I mean, nobody can predict things like Enron or whatever. Like, there's just no magic, right? That's what I'm trying to like get at. It's think probabilistically rather than thinking about like, I want to avoid very specific risks, so I got to get very specific data on every single customer. No, think about your decisions as being on a spectrum, and you want to shift them towards better decisions over time. And that's what you want to measure. That's the calculated risk that you're talking about. Have you actually calculated?
So obviously, people hire me to collect on bad debt, right? When I'm working with clients, I see many of these clients are struggling to find a good process, or they have a process for follow-up, but it's rarely followed. I mean, how is this going to help them make that decision to turn somebody over for collections sooner, so that they can make a decision based on facts, not feelings?
Yeah, because at the end of the day, I think it should be a policy matter.
Absolutely,
right?
100%.
If a buyer is in a certain situation or these 10 situations, then it must be handed over. Stop trying to hold on to it because the sales guy is desperate to keep that customer, keep those sales. And a policy that's followed is one which everyone then trusts and then believes in, and then has the benefit of, if you tweak it over time, you say, oh, we're being a little bit too aggressive here or a little bit too soft, you can make those changes. But if everything ends up being decisions in the moment for that certain circumstance without very good documentation around it, people lose trust in that the policy is actually being applied correctly.
Yeah.
So that's one thing I struggle with. But the other is really, at the end of the day, you should hand somebody over if they owe you a lot of money and the prediction is it's just going to get worse. You're not going to get the money out. So stop. That's what predictive analytics tell you. They tell you, like, this thing is going to keep being a millstone around your business's neck. Stop dumping your money into that.
Well, you don't have to. You got to think, not only do they just owe your company money, but they owe lots of other companies money too, right? So you have to kind of be under that assumption, because chances are they're not just picking on you, right? There's a lot of companies they owe money to.
Yeah, if you take too long till the very last moment, then you're not going to get the recoveries.
You show up to the prom and the punch bowl's empty, right? Like everybody else is already drinking the Kool-Aid. So
yeah, so knowing when to hand over is also very much a question of like what is likely to happen in the future. And you know who has the best data to be able to predict that? You. It's in your system. And you just need somebody to help you to model that and show you that picture that you can make better decisions. But again, I think it should be policy driven. This is where it gets hard, because like I've seen this. You like show it to the client, they're like, oh, that's one of our important clients. How can you say they're such a high risk and that they're such low profit? I had one recently. I mean, they were like, oh no, we would never give them that much credit. I said, you must give them that much credit because that is what you have been giving them.
That's right.
You say your credit limit's here.
You've gone over there.
I can see in the data that they're spending 2-3 times that. The AR is 2 or 3 to 4 times that.
A lot. That happens a lot.
Put your credit limit up there. And they're like, no, we can't because we're not allowed to. I said, but then you shouldn't be trading
doing it.
Oh, but it's a good client. I'm like, okay, well, this is the problem. You're not applying the policy. You need to change the policy then. But it's hard. It's always easier to kick the can on the road. Then when things go bad, then obviously the question is going to be asked, why did we make a bad decision? Yeah. In that case, with that particular one, I actually see that customer is good. They're actually being overly conservative, but maybe they need some credit insurance to give them some comfort or some other security because it's a big customer for them. And I understand, but they're playing with fire. They're sort of covering their eyes, hoping that it's going to be fine, but then still saying, no, we're not going to take those risks. But they are.
They're already doing it.
Yeah. And look, it's easy being on my side of the fence. If I was on their side, I would very much be struggling with the same decision. So none of us here, like, you and I, we both know that these are real people talking to real businesses. These are hard decisions to take.
Sure.
But I do think with better analytics, that gives you better predictiveness, and you've got in place there the scenarios, the analysis of that, and really good structured decisioning. It makes it easier for people to say, okay, we have to pull the trigger now and do this. And at the time, this is the best analysis that could have been done. And if anybody can come up with a better idea of how to analyze this, great. But for now, this is the best that there is, and we're going to move ahead and take and make this decision. Do the handover, move on, find other customers. It's just unfortunate that that's a reality. Sometimes you've got to do it.
So much like people in dealing with their credit policies and bad debt, there's emotion that's involved in it, right? And there can be emotion that's involved in the analysis part too, right? You don't know what kind of mood the person is that's analyzing all the data. You don't know, what they may have heard from the salesperson that could be, having swaying their decision somehow in the back of their mind, or what have you, right? So this is actually taking the emotion out of the analysis and working strictly off of logic and the facts and the history, which is like, you can't beat that, right? Like, there's nothing better out there at this point that's going to be making the decision based on actual true data rather than just, how somebody's feeling one day, or, what they've actually seen. They may not have seen the whole picture, right? You're getting the whole picture, and there's no emotion in this.
Yeah, when we're human, we're not aware often of what the weightings of the model are in our head. We've got a model,
right?
We're like, oh, I think this is high risk, or I think this is low risk. Why? I can't. The 5 C's. Okay, but what was the weighting you put on the first C? Oh, I don't know. What's the weighting you put on the second C? That was good. How much is good compared to the guy you did last week? I don't know. Like, there's no real model. There's just a very, very vague sense of what you're doing. And like, some companies have like decent Excel things like that. All that's fine, but none of them are predictive. All of them are looking at past information and going, based upon this ratio, and plus a few other things that I've got in my head. Push some of the things, factors up, some down. $10,000. Okay, cool. Moving on.
The price is right with your credit.
The problem is, in a month's time, or any time in the future, when you want to go back and review, why do you make that decision? It's impossible. Nobody knows. And if you can't review, you can't improve.
Yeah, you have to be measured in order to improve them, right? You have to track data. You have to measure things. Otherwise, how can you improve them, right? And I think that a lot of departments and credit miss out on that. They just don't do it.
Look, I'm not blaming them because they generally haven't had the investment, right? It's been too expensive to do something like what I'm doing now, but also the
technology hasn't been there either, right? I mean,
IT budget gets spent on everything else except on credit, and they're still sitting there with their paper reports. And it's not that they want to; it's just that it's been such a low priority, and I don't think there's been enough investment in that. So, I'm hoping to help with that. I got a lot of genuine sympathy for people in credit. I've worked with them, and I've seen them, and I've hired people who were credit managers, and they're like, how hard of a job this is. This is like people trying to do miracles,
right?
Trying to build a castle with a fork and spoon. You're gonna try, and they do a lot of work. So there's nothing like I don't blame anybody in that space that they haven't done this yet, but it just hasn't been prioritized. But to be fair, also, I don't think there's been a good enough solution to spend the money on previously. Automation stuff is good, like automating your follow-ups, credit apps, like the stuff that you guys do. It's good, but in decisioning around credit, it's been very poor. It's not like you have in the consumer credit space where the likes of FICO and so forth have invested billions, and there's a lot of product there available. In our space, trade credit, there just hasn't been anything that people could use reliably. I've heard of a company using ChatGPT to try and do credit limits. Yeah, they stopped within like 10 minutes. I could have told them like that definitely won't work. But I think I threw a credit report in and said, make a decision. It was disastrous.
That's not going to work.
Yeah.
Doesn't have all.
You got to spend a bit more than ChatGPT, but the
Right. Yeah. Oh, that's funny, man. That's hilarious. Well, is there anything else that you would like to talk about in regards to Veruta and what you guys are doing there? I mean, I think I know. I mean, is there anything in particular that you're wanting to tell people here?
Yeah, look, we're in a learning phase, so probably we'll stay in the learning phase, but it's very much a what do we need to nail? I mean, I think we've already got some really good things, but making sure that for each specific industry, we really start to get very good at the modeling, at the simulations, and trying to understand the differences between them. Like we specifically want to focus right now on companies that do a large amount of distribution. There could be a manufacturer as well, but if they're doing their own distribution, great. Of any sort of physical goods, beverages, water, food, CPG, but also things like auto parts, anything. You distribute something. You got a warehouse sitting there full of stock. That's taking up a bunch of cash. The other cash pile is sitting in your customers' bank accounts. You're waiting to collect it.
Yeah.
And essentially, if you're a distributor, that's a huge part of your profit margin gone if you aren't getting good control over your credits on your collection side. So those are the ones we see as most needing this tool, and we've got typically over 1,000 customers or more. 10,000, 20,000 would be great. When we're talking, just got 80,000 customers. Fantastic. Doesn't really matter beyond that, as long as it's enough that you can't manage it yourself and you want a tool. So, yeah, but at the same time, building models for every single customer is quite a skill. We do have guys who are doing that with us, and our tools are very powerful at this. But the final point is that we're still learning with every single niche and every single customer how we're going to nail this. So there's good things going to come out, and we'll see how we learn for the next year or so. And if you want to be part of that journey and be one of the earlier customers and get it a bit cheaper, get it a bit more customized to you, then now's the time to chat. If you're somebody who needs 100 other people to have bought it already, then we'll get to you later. Like this is not for you. This is more for the guys who like to try new things and who really have a problem right now and are willing to work with somebody to solve that problem. So yeah, that's to be my final wish, is to work with some really forward-looking credit managers and CFOs for this year.
Absolutely. Well, I'm going to make some introductions for you for sure, man. So
yeah.
I know you personally, and we've had a great relationship over the years, and I know the types of things that you're involved in. So I'm super excited to see what you guys do over at Veruta, and looking to be part of it myself, and help you guys spread the word, because I know what type of guy you are, and I know what you bring to the table. So super excited to see what you guys are doing, man. Thank you for coming on the show, man. Really, really appreciate it. Thank you.
We're very excited. It's going to be an awesome year, and looking forward to working closely with you as well.
Awesome, man. Well, thank you, Dom, for being part of the show, man. I really appreciate it.
Awesome. Cheers.